topic about year-end adjustments. We wouldn't get here if we have not prepared different accounts for the business. That means we have prepared our accounts, we have prepared our ledgers, we prepared the cash book, we prepared all our original book of original entry. But we have to put in mind that there is what we call accrual concept. Which means expenses of a business, income of a business should not be recorded until they are used or incurred. So we would not record anything for you as a business in terms of what you get, or in terms of what goes out of you, when those things are not yet used. That is why we have to make adjustments to our book of accounts. So look at what I wrote here. There are different reasons for the business we need to make adjustments to the account at the end of the year. The adjustments are needed as financial statements are prepared following accrual concepts. So we will not prepare, according to the International Accounting Standard, the IAS, we have to prepare our accounts or our financial statements with the necessary requirements or rules that guides the IAS. So, what is accrual concept? Accrual concept requires that revenues and costs are recorded in the period they are incurred, not in the period they are paid. We might make a payment now, but we won't record the revenue or the expenses if we have not incurred them. I could pay you right now for something that I want you to do. But in as much as I have not done it, it should not be recorded in your book. Do you understand what we're talking about accrual concept here? It implies that revenues and costs are recorded in the period they are incurred. The revenue, that is the money you make in the business, the cost, the expenses in the business must not be recorded until they are incurred. That means you have used them. If I have paid you for something, if I have not gotten that thing from you, you should not record it. If you have paid me for something and you've not gotten what you want from me, or in terms of the service, I should not record it. That is what accrual concept is about. Do you understand accrual concept here? Revenues and costs must be recorded when they are incurred. That is accrual concept. So that is why it is important for you to make adjustments to your financial statements. To take out those ones that have paid for, and to take out those ones that have not been paid for. Do we get it? Do we get it, please? So adjustment could be accrual or repayment. Adjustment could be accruals or repayment. When we talk about accrual, income or expenditure in the accounting year, that is, we call it accrual because as a business, if you are making adjustments, not only you that you are getting the money, sometimes you pay others too for something to get done. So you are going to make adjustments for those repayments, you're going to make adjustments for those accrual. What is accrual? The money or the expenses that has been incurred this year that you are owing. Income or expenses owing in this accounting year. You've collected money, but you've not done the job. It is accrual. You've bought some things that you have not paid for. It's accrual. Do you get what accrual is here? You collected money, that's an income, but you have not done the job. It's accrual. You got something. You've gotten the service that you have not yet paid for. You've not yet paid for. It's accrual. So that's why we said income and expenses owing in this accounting year. We are owing them. We are not yet paid. We've not yet paid for them. It is accrual. Do we understand accrual here? Do we understand accrual or not? Do you understand or not? Yes. Accrual occurs when there is an income you've received for a service that you have not rendered. When there is an expenditure you have paid for, when there is an expenditure that you've received but you have not yet paid for, they are all accrual. Then we have prepayment. For prepayment, it is income and expenses in advance for the next accounting year. Now, I have collected some money, but it's not going to come for this year. It's for the next accounting year. I have gotten some services that I'm not going to pay for this year, I'm going to pay for them in the next accounting year. This is what we call prepayments. You prepay, that means you pay now ahead of the future accounting year. Prepayment. Accrual, you've received now, but you have not paid for it in this same accounting year. Do we get the difference here? Yes. Here, you've received or you've paid for next accounting year. Here, this accounting year, you have received or you have done something that you have not paid for, but it has to be recorded in this accounting year. That is accrual. Do you get the difference here? Look at what I wrote about accruals. Accrual. These are expenses or income outstanding in the financial year that was recorded in the financial statement. So it is recorded, it is accrued this year in terms of income and expenditure. But it has to go with this financial year. We have to record it in this financial year. That's why we call it accruals. It has to be recorded. If it is income or expenditure, it has to be recorded in this financial year. That's why we call it accrual. We have two types of accrual. We have accrued expenses, accrued income. What's an accrued expenses? These are expenses that are incurred but not yet recorded. All accrued expenses such as electricity, postage, telephone will be transferred to the statement of profit or loss and other comprehensive income. When we talk about accrued expenses, they're going to be a debit balance. Why? Because they are expenditures. All these expenses, you've taken them, but you've not paid for them. And they have to go for this year. So they have to be transferred from each ledger. You're going to have a ledger for postage, a ledger for telephone, a ledger for electricity. All these ledgers, all the accrued expenses will be put together and transferred as accrued income. These are income due to the business, but are yet to be recorded in the accounts of the business. Here, you are giving services to different people or customers, but they've not yet paid for. And you have not recorded them in your financial year. Both of these and these must be recorded in this financial year. These are the expenses of the business that has not yet been recorded. These are the income that is due to the business that has not yet been recorded. That's why we call them accrued. They have to go for this financial year. Then we go to prepayments. For prepayment, these are revenues or expenses of the business that will be recorded in the next accounting year. This one goes for this year. Prepayment goes for the next accounting year. So we have incurred different expenses, but it's not going to count for us for this year. It's going to count in our books for the next accounting year. That's why we call it prepayments. So we have prepaid expenses and prepaid income. What is prepaid expenses? These are the future expenses of the business that have been paid for in advance. Here, I have paid for insurance for the next 12 months. This is February, right? So that means I've paid for next year, January or February. So the 2 months I have paid for will be considered as what? Prepaid. It will be recorded in the statement of financial position as other receivables. Get the point here. Prepaid expenses. These are expenses that we're going to, but we are paid for them right now. It is an expenses for us now, yes, but it's going to count for the next year. So we're going to record it in our statement of financial position as other receivables. So we are yet to get those services, but we are paid for them. Do we understand or not? Do we get it or not? Yes. Prepaid expenses are expenses that have been paid for. We're not going to, I paid for electricity. Okay, I talked about rent. This is my house. This is my house. I've paid for the rent. I've paid for the next 2 years. So it counts from February to February. So this year is my accounting year. So from February to the rest will be accountable for next year. So the value for that next year is what we call prepaid expenses, which is other receivables. It's an asset for you because Prepaid income. These are the future revenue of the business, these are the future revenue the business has received, but the business will provide the service in the accounting year. As we have prepaid expenses, we have prepaid income. Now I have received rent. I have a house. I have received rent from you for the next 12 months. And 2 months is gone for this year, right? So that means you have 2 months additional for next year, yes or no? So the value for those 2 months is what? Prepaid income. It will be recorded in our statement of financial position as other payables. It's a liability for the business. It's a liability for me because I have collected money that I have not yet serviced. Do you get it? I have collected money that I have not yet serviced. That is prepayment. Here, I have paid for the service I have not been rendered. Prepaid income, other payables. This is an asset. This is what? A liability. Because you collected money and you have not done the job. That means you are owing the person, yes or no? Do we understand? Any question about prepayment now? Prepayment is an outstanding, an advance payment for the future purpose, or for the future reference, or for the future accounting year. We have prepaid income, prepaid expenses. Prepaid income, these are the money we've received for the services for the goods that we have not sold. It is a liability. Prepaid expenses. These are the payments we made that we have not yet received. I give an example about insurance. Insurance will come for the next year, but I have paid right now. So because I have paid right now, for me as other receivables until it is done. So the insurance company is owing me. That's why we call it other receivables. If I am owing you, we call it other payables. Is it clear? Is it clear, please? Yes. Now we go to nature and the use of provision. Why do we have provision? We have provision because we are not certain about what happens in the future in terms of the value of the asset, in terms of the amount of the asset. Listen, when you are not certain, when you're not sure, provision. You make what? Provision. That means, okay, this is going to be an estimate of what could happen. This is a marker. Let's assume this is a marker. I wouldn't know the value of this marker in the next 2 years or in the next 6 months. So I am making a provision for it. Because I cannot be certain about the value of it in the future. That's why we have provision. Do you understand what provision is here? So please look at what I wrote. Provision is the liability of uncertain timing and or amount. Uncertain timing or amount. We don't know what time. We don't know which price. We don't know the value. We don't know the time. It's an asset. It could stop now. It could stop in the next 5 years. It could be valueless now. It could be valueless in the next 3 years. We don't know. As a result, we make what? Provision. That's why we said it's a liability of uncertainty in terms of time, in terms of amount. Do you understand provision here? It's a liability. Now what is liability? You are owing a debt to the third party. We are owing. So whenever we make provision for a laptop, we are making the provision for this laptop because this laptop will continue to be used. And we have to maintain the laptop, yes or no? So we are making the provision for this laptop in case it breaks down. We don't know the timing. We don't know the price at which we're going to sell it, the amount. Do we get it, please? So that's what provision is. So let's go in deeply about provision, called provision for depreciation. What is depreciation? Depreciation is the wear and tear of an asset. We did that before, right? When the asset starts losing its value, it's depreciating. The only thing that does not depreciate is the land. Land will what? Appreciate. Land will what? Appreciate. It doesn't depreciate. But other non-current assets will depreciate. So we make provision for depreciation. So making provision for depreciation is what? This is the estimated value of a non-current asset. A non provision for this laptop. This laptop is going to last maybe the next 4 or 5 years. The provision we made for this laptop is what we call provision for depreciation. What do we do with it? In our statement of financial position, we're going to have the value, the cost of this asset, which is the laptop, the depreciation value of this laptop, those that do not pay back are called irrecoverable debts. The debt goes back. You are unable to retrieve your money from the trade receivables. So for irrecoverable debts, it is certain. Why is it certain? It is certain because not everybody will pay back. You're not sure. Look at what I wrote here. Irrecoverable debt is certain, but provision for irrecoverable debt is a provision that all outstanding payments will be made by debtors. There is irrecoverable debt. There is provision for irrecoverable debt. Debt means that the debt has goes back. We are unable to get the money from our